Let's talk about the Buffett indicator, which, if you're not familiar with it, it's the total value of all publicly traded stocks divided by the GDP ratio. In a Fortune magazine interview back in 2001, Warren Buffett referred to it as probably the best single measure of where valuations stand at any given moment. Gentlemen, given the chart that you see on the screen, what is an investor supposed to do with this ratio today? Adam, let's start with you.
Well, you look over the last year-ish, Buffett's been selling a lot of equities, right? He's sold down a huge chunk of his Apple stake, even though he still does own a lot of it. He sold down a huge chunk of Bank of America. And all the talking heads are like, oh, it's portfolio management. I mean, and then you look at his favorite statistic, which suggests that the world's about to end. And it just makes me think of one of my favorite Buffett quotes. It's my favorite, but I'll probably still say it wrong. But the core part of it was, you want to be careful when there's not a cloud in the sky, and you want to be greedy when you're in the middle of the storm. And right now, the S&P at 25 times earnings, even if you look out 3 years with 10% earnings growth, you're still at 18 and a half times. It's over 6,000. You got the Magnificent Seven trading very strongly. All the things we've just been talking about in the Buffett indicator at, close to 200%. Feels like that's a pretty cloudless sky, and it might be a good time to batten down the hatches and be aware that these good times don't last forever.
Austin, what are your thoughts?
In the late 90s, everyone was saying that Buffett was washed up because he was leaving the market as growth equities continued to race higher. And as you could see from this chart, in the late 90s, the actual multiple wasn't near where it is today. So it shouldn't be a surprise that Buffett's loosening up on his equity allocation as he sees some of the animal spirits kind of push markets higher in this environment. And I would just say, over the last 25 years, Buffett's seen his net worth double multiple times right after he was washed up. And in reality, people should be looking at the facts, understanding what's going on to fundamentals of companies and valuations. If you're really focused on that, the likelihood that one trend, whether it be the internet in the 90s or whether it be AI today, is going to significantly increase the market cap of equities beyond GDP growth is kind of outrageous. And people should position their portfolios accordingly. In this market, it likely means a little less Magnificent Seven. It likely means a little bit more small cap, a little bit more kind of blue collarish type companies that tend to do well in any environment. And also, quite surprisingly, probably a little bit more international, right? International has been tossed aside for the last decade, and these things tend to move in decade increments. So expect international to kind of come to the scene at some point here in the next few years.